I just want to take a pause here, Terry, because we did speak to the CFTC. They gave us this statement. The agency has long analyzed the issue of perpetual contracts in U.S. derivative markets. The CFTC's mission is to promote responsible innovation and fair competition, and the commission will not hinder lawful innovation, as we understand it, too. They sought a comment from the industry back in April of 2025. And the CME actually provided perspective on this, and that was, a while ago. So I didn't want to put that out there, but I'm going to take the other side because you were able to explain your side of it for a while. Some might say, exchanges like yours, you're afraid of this being a competitor product. I mean, that's what we saw in the stock market. I mean, your stock was under pressure because of the concern that this would draw volume away from other products that you've launched recently that are very popular, like zero DTE options, for instance. What do you say to that? I mean, do you think that this will be an impact?
About the impact is hard for me to say, but if you think this is a self-dealing thing or a complaint that CME doesn't want this type of competition, I've spent 30 years of my career bringing incredible markets to the United States and growing them exponentially. And we have done that. All of us have done that collectively together. We are going backwards now. We are creating the regulatory framework for leverage. This is 2007 for retail. So think of 2007 for homes. This is 2007 for retail. They have so many products that they're going to have leverage to. The auto liquidation process that works with perpetuals, that could trip over and then cause cascading effect going down exponentially. They have their own market makers at Kalshi. This is not too dissimilar than when I called Sam Bankman-Fried a criminal. I went through the process of testifying with Sam, saying that his model could be very disruptive to the financial system. This is no different. This is absolutely no different, Melissa. So it's not self-dealing. I don't want casinos in exchanges. I want to have products that people need to trade. The question is, because a perpetual does not expire, makes it more valuable, is ridiculous. It does not lend to the credibility of pricing. I clearly outlined how a perpetual works. It works by a funding rate, which ties it to spot, which means you cannot forward hedge that product with any credibility of a future date of delivery or cash settlement process. So it's not a credible product. It's a leverage product. That's all it is.
These are and first of all, full disclosure, Terry's been a friend for many decades. And you know my view on you. I've talked about it on the show. I think he's one of the great CEOs in the country. And with that said, I mean, you've had competition like this come around many times over the decades you've been at CME. You welcome that competition, but you also realize that you're in a position. So explain to the folks at home the difference between products that help people hedge risk and these products, because your products are actually helping the farmers and the bankers and all those things hedge the risks that they find in their day-to-day business.
So I always say, Guy, that whether you trade CME or not, it's critically important these products are out there. The great late Milton Friedman said to me before he passed away, he said, Terry, if we did not have futures contracts, we would need to invent them to move forward. That's a pretty powerful statement by one of the smartest men ever to grace the earth. And what I think is important, Guy, is these products for farmers, for energy, for interest rates, if you don't use them, your mortgage is dependent on it, your price of your gasoline is dependent on it. And if, in fact, you don't have risk management tools, then the cost gets passed on to the consumer. The U.S. debt is a great way to look at it. We have $39 trillion of debt. We have a $28 trillion GDP. You don't need to be a math wizard to see where this is going. So in order for us to continue to sell debt, we need to place a forward market to lay off that risk. You cannot lay off risk in the cash market, in the forward treasury. In the treasury market, it's not a forward market. So that's why it's important, because your mortgage is depending on it and your credit card bills are depending on it. All this is a part of that 10-year curve. So you need to have futures markets, whether you participate or not, in order to run your life more efficiently.
There might be an argument out there that says, if you're a retail investor and you want to use perpetual futures, that's on you. That's your decision. But it sounds like you're saying that there's actually a ripple effect, maybe potentially negative effect, that goes well beyond that one trader that decided to engage and use perpetual futures. What is that risk to the markets? There's
multiple risks. But here, think of it this way. The way perpetuals are set up, they incite bad behavior. Why? Because of the way the funding rate works. So if you're short a market and I'm long in the market, I'm right, I still have to pay you even though you're wrong. So that could incent you to trade even more, because you know if it goes against you, I have to fund your bad position. That is not a pure market. You know, I know Tarek tried to come on and say that these are the purest way of doing
the
the future.
CEO of Kalshi.
The CEO of Kalshi. This is the most impure way to participate in a market. So I just think that is the argument, Melissa. They're very cumbersome.
Terry, you mentioned in 2000.